You guys want to call it?
Sure.
I'll just show it to you.
Tails.
Heads.
You should know. You pick.
You pick, man.
You're going to.
We'll go second.
Oh, okay.
Full con.
Alright.
Oh, you want to go second? Alright. Yes. Just give us a couple minutes. Okay. Yep.
Just let us know when you're ready to finish.
Okay, can I do one?
Yeah,
thing?
that's
I'm
fine.
sorry.
Of course.
Okay, tell me who you are.
So we're Mission San Jose,
Okay.
and we're the pro team speaking second.
Okay.
And then we're university, we're con first.
Okay. You can go ahead and start.
All right, opponents ready?
Yep.
Side?
Yep.
Coach?
Yes.
Okay. Side I negate in contention one is opportunity zones. Opportunity zones are impoverished areas in which tax incentives, such as tax concessions, are offered to encourage business development and provide jobs for residents. The Economic Innovation Group reports that the new 2018 tax proposals for capital gains have reinstated opportunity zones from Clinton's tax plan. These opportunity zones are low-income areas with few jobs that need the most investment. Specifically, Jim Tankersley from the New York Times reports that the 2018 plan creates special provisions that allow for 100% of long-term investment to be permanently excluded from the capital gains tax. Accordingly, Stacey Kirsch of The Hill reports that with the addition of opportunity zone tax breaks in the new bill, low-income communities could see a net investment of $3 trillion in currently frozen assets. However, abolishing the capital gains tax destroys this benefit. According to Gabor Ostos of the Open Society Institute, investors prefer investing in large cities rather than small, impoverished ones. Thus, abolishing the capital gains tax removes any incentive to invest in these opportunity zones. The impact is poverty. According to John Hamm of the University of Maryland, opportunity zones lower unemployment by 2.6 percentage points. That is why Sean Lowry of the Congressional Research Service reports that opportunity zones reduce local unemployment and poverty rates by 2.6% and 20% respectively. Contention 2 is investment in small businesses. According to Sean Green of the Yale School of Management, small businesses are the engine and backbone of the economy because they make up 99% of all firms and create 60% of all jobs. There are two ways that the capital gains tax helps startup investment. First is Section 1244. Alan Ellentuck of the American Institute of Certified Public Accountants explains that through Section 1244 on the capital gains tax, investors are allowed to deduct small firm investments that lose money from their income tax. For example, if someone with a salary of $50,000 loses $10,000 from a big business investment, that person pays a $50,000 income tax. On the other hand, if that same person loses $10,000 from a small business investment, there is only a $40,000 income tax. Second is Section 1202. According to Tina DeSanti of the Tax Advisor, Section 1202 of the tax code excludes investors from paying 50% of the capital gains tax if they are investing in a small business. Todd Hickson of Forbes explains that small business preferential treatment of capital gains is a strong incentive to invest in small businesses. James Pedahokis of the American Institute corroborates, finding that this provision in the tax code narrowly targets entrepreneurial startups over more well-established firms. However, abolishing the capital gains tax terminates both of these benefits. According to Gordon Keith of Harvard, without the capital gains tax, it would be extremely difficult for small firms to raise equity as there is no preferential system. On the same lines, Kevin McPhee of the National Tax Journal concludes that abolishing the capital gains tax increases investment to mature firms by 4.5%, but decreases investment to smaller firms as investors have no incentive to specifically invest in startups. The National Bureau for Economic Research explains the warrant, finding that investors naturally play it safe and direct the majority of their funds towards big, established businesses over smaller, unproven ones in the absence of incentives. That is why Andrew Torrey of the University of Frankfurt finds that the abolishment of the capital gains tax would lead to a 22% decrease in the number of small firms in the short term and a 20% decrease in the long term. The impact is unemployment. According to Michael Mazurov of the Center of Budget and Policy Priorities, startups initially make up 3 million jobs per year and 2.4 million more in the long term. That is why Young-Suk Lee of Stanford confirms that a 10% decrease in small businesses decreases employment by 3.5%. Thus, the capital gains tax saves nearly 168,000 jobs every year. Thus, McGee.
Can I see the Tory evidence? That 20% loss of small businesses?
Sure.
I can just look at it during cross, or during this case. Is that fine?
I need that.
Okay, then I'll just look at it right now. We'll run a little bit.
It's right there. It's hard. Well, I need
Wait.
Here you go.
You guys okay with that?
Yeah, that's good.
Okay, perfect.
15 seconds. Alright, everyone's good? Devash and I affirm the resolved. The United States should abolish the capital gains tax. Contention 1 is increased investment.
Gollenbeck, an investment executive in 2017, finds that because investors use a risk versus return approach, the structure of the capital gains tax makes investors more reluctant to sell their assets because returns are lower than they would be without the tax. Letiria of the Hill in 2018 writes that U.S. investors have over $2 trillion in unrealized capital gains in stocks and mutual funds alone because of this lock-in effect. Hence, Hendry of the Washington Examiner writes that capital gains tax is directly tied toward lower economic output, lower wages, and less employment. However, Gosadilla of the American Council finds that reducing the capital gains tax can increase capital returns by up to 48% on face. That's why he concludes that historically, reduction of capital gains tax has always led to an increase in investment with a significant improvement in the economy over time. The increase in investment is important for two reasons, and the first is entrepreneurship. Foster of the Tax Foundation in 2017 finds that this capital gains tax uniquely harms investment in small businesses because investors need a reasonable expectation of extraordinary post-tax returns to outweigh both the tax they have to pay and the far more likely event that the businesses don't succeed at all and their initial investment will be lost. For these reasons, Mitchell of Forbes found that a 1 percentage point increase in the rate of capital gains tax was associated with a 3.8% reduction in funding for these businesses. However, Moore of the Institute of Policy Innovation finds that eliminating the capital gains tax provided the much-needed boost for these entrepreneurs, writing that empirically, the stock of smaller firms outperforms that of larger corporations during periods of low taxes. Every 5% cut in capital gains tax translates into a 12.5% increase in small business stock value. For these reasons, Criticos of the University of Potsdam finds that the impact of reducing the capital gains tax and thus increasing entrepreneurship is tremendous. It would single-handedly increase economic progress by increasing competition and directly increase the number of jobs being created in the hundreds of thousands. The second reason is investment. The second reason increased investment is important is because of debt. Mitchell of the Foundation of Economic Institution writes that companies seek investment by either selling equity in the company or applying for loans. Under the current law, paying out capital gains on equity is taxed twice, first via corporate income and second via the capital gain. This double tax makes debt a much more attractive option right now because interest is deductible. He continues that debt bias causes many significant economic distortions, inequities, and complexities, which is why inefficiently high debt-to-equity ratios in corporations discriminates against innovative growth, impedes economic growth, was recently found to cost the public welfare as well. However, there is hope. Mitchell concludes that ending this double taxation by abolishing the capital gains tax would put debt and equity on a level playing field and restore an efficient equilibrium in the American economy. In addition, this would help America recover from inevitable recessions faster. Amadeo of the Balance in 2017 finds that getting rid of the high debt eliminates three major harms to the economy. First, obviously, it would lower these interest rates. Second, inflation would allow repayment of high interest rates, which causes foreign governments and investors to be willing to invest in the U.S. economy. And third, the greatest danger would be Social Security, which can only be saved by raising taxes and slowing the economy. Because of all of the above reasons, Mitchell of Forbes in 2017 writes that empirically, in Switzerland, elimination of the capital gains tax had a positive economic significant effect on the long-term income, and the size of the economy tripled, and thus we affirm.
Can we call for a piece of evidence? Sure. That's your, it's your capital gains means a 48% increase in investment.
Yeah.
I think it's not going up, so.
Yep.
I got it.
No, okay.
Oh, you have the PDF.
We have a
I can-
card
I
with
can pull up
contact
the PDF on it.
if you want to.
Sure, yeah.
Yeah.
No, it's just goes to here. No, go back.
Yeah, it goes up into the PDF. There you go. Now just Command F48.
Yeah, one second.
Yep, that's it. You guys are using prep?
Can you highlight the specific
Yeah,
words?
it's highlighted.
It's highlighted.
Sure.
Oh, wait.
Yeah, we're sorry. It's not true. Thank you.
Alright, so now.
Oh, okay, cool. Alright, I'm ready for crossing it. Okay, is everybody ready?
Yeah.
Okay, in a world without the capital gains tax, like how, as an investor, why would I be incented to invest in small businesses?
Because they're lucrative opportunities that have fast-paced growing businesses that can sometimes yield higher profits than
Wait,
corporations.
first of all,
but
can I
really
respond
quick,
to
and I
what
just
you
finish
first
my
said?
question, right?
Sure.
I finished my answer, sorry. But in a con world, those benefits of a fast-growing sort of entrepreneurship side is outweighed by the risk factor of a tax impeding on my ability to profit.
Okay, let's talk about what you first said. You said that like startups are like really profitable if you invest in them. We would say
Sometimes, yeah.
that 90% of startups actually fail.
True.
So like investing in a startup is a really big risk,
Yeah.
and without any sort of tax incentive, it's very unlikely that people are going to do it.
So, I mean, I think we're both talking about the same thing. It's a big risk. But the problem is, when you put a tax on that risk, investors immediately, like, whether or not there's a comparative advantage between, like, maybe it's easier
why
for
does
me
the
to...
comparative
Okay,
advantage not matter?
let me just explain this to you, right? So, I know Apple's a safe bet. So even if there's more tax on Apple, I'm still comfortable putting my investments in there. But if I see the small, like, Kindred AI, that's where my dad works, let's say, it's a startup, all right? If I see Kindred AI is coming up, but they have like another 15% tax there, I'm not confident in their ability to give me returns versus Apple's ability to give me returns. So even though the tax is comparatively higher, I'm still more assured in that. But the tax is 0% flat everywhere, my mindset now becomes, I can take risks on entrepreneurs because there's no harm towards
Wait,
myself.
do you agree that in like investing in large businesses is safer than investing in startups?
Exactly. Which is why the comparative advantage doesn't matter. That doesn't change the mindset of, if I invest in a big company, it's safer. So if there's any deterrence effect from investing in a small company, they will not do it. The only chance of investing in a small company is by making sure there's a 0% tax rate. Otherwise, it won't have it at all, because
Wait,
like you
but
and
if
me agree, a large company is a safer bet always. And I
Okay,
have a question.
Sure.
So when you talk about small businesses in section when you talk about opportunity zones in housing and urban development,
Sure,
right?
yes.
The recent 2018 tax plan, what policy is that an extension of?
Well, I mean, this like opportunity zone policy was from the Clinton policy, like
Yeah, so the Clinton policy. So what
Yeah.
was that original policy?
that like the creation of these enterprise zones.
It was called the LIHTC. Do you know what it did?
You can explain.
It
more.
made it so that if you make a capital gains investment, the deduction comes off of your income. So basically, I get tax credit. So even if in a pro world I invest $10,000 in an opportunity zone, I get tax credit off of $10,000 in my income.
So
You
why
understand?
does that, so why does
So
that change
whether
anything?
capital gains isn't the link into opportunity zones. Your argument is not unique. I get access to all of your impacts. There is still a comparative advantage
Wait,
in my
no, I
mind.
mean we tell you in case literally that like if I'm an investor,
Yes.
the reason why I would pick to invest
Mhm.
in a low income neighborhood is because I would receive less capital gains tax on the profit that I take from investing in that.
See, that's the
neighborhood.
disparity that we're going at, right? The original form was the LIHPTC, and the 2018 tax credit is the 2018 reform is an extension of tax credit, which means if I invest in a capital gains, I get tax credit no matter how I invest. So on my income, right? So any $10,000 that I invest, that 20% that would go to my taxes, it doesn't need to come out of my capital gains tax. It can still come out of my income tax. So even if a capital gains tax does not exist in a pro world, I still get the credit off of my income tax.
Alright, we're-
So the comparative advantage. Oh, sorry, I wasn't timing.
Can I say one piece of evidence?
Yeah, sure.
I think you were just talking about in class.
Yeah, can we see that?
I mean, I haven't read it yet, but sure.
We didn't read it in the round yet.
Actually, we can just call for that later.
Yeah.
Okay,
That's
yeah.
what I
Yeah.
Alright, so we're gonna start prep time. We'll start that now. That'll be enough. Alright, so we have 55 used right there, so we have 50 left.
Alright, opponent's ready, partner ready, judge ready. Okay, then I'll begin. Let's start off with my opponent's first contention where they talk about investment. There are three responses on phase. The first response is that we would say you cross-apply the second subpoint, our first subpoint on the second contention, where we tell you about how in the status quo, when you invest in a small business, you can soften failure because you can consider regular losses as capital gains losses. That's super important because the tax policy center tells you that when you abolish capital gains and when you remove this exemption, that actually increases the risk of investment. That's super important because when you increase the risk of investment, you actually see an overall decrease in investment. Let's move on to the second response, which comes from McPhee, who we specifically said in case, who tells you that even if there is an increase in investment, there will be a 5% increase in big businesses. That's super important because the Center on Budget Policy Priorities tells you that big businesses on net decrease jobs, but instead we would say you should prefer impacts to small businesses because small businesses create jobs and they're the backbone of the American economy. So to the point where the majority of their investment that they're talking about goes to big businesses, this is actually a reason to vote for us because we are the only ones in this round that support small businesses. But third, what Leonard Bernstein of the Roosevelt Institute tells you is that when these companies have increased profits, they won't actually use this to increase wages of their workers, but instead they'll just pay their shareholders and they'll just pay their salaries even more. That's super important because my opponents try to make this impact that they'll increase overall wages, but in reality this won't happen. We would say look to reality and we would say look to empirical evidence. But then let's go to where my opponents talk about the lock-in effect. 3 problems here. The first comes from Charles Holt of the National Tax Journal, who tells you that the lock-in effect my opponent is talking about is a severely minimal impact, and there's really no reason to vote out this because even if you grant them this warrant, their impact is extremely marginalized. But second, what Keith Butters of Harvard tells you is that in a study, when he actually interviewed investors, he saw that only 7% of them actually considered the lock-in effect as a consideration on whether they would bank in on the investment. So really, you aren't going to be seeing the lock-in effect have much of a significant response. But then, what Chuck Marr of the Center on Budget Policy Priorities tells you is that even if there is a lock-in effect, that would only have a short-term effect and it would only displace investment in the short term. However, in the long term, the lock-in effect won't have much of an effect. So overall, even if my opponents do win this whole thing, we would say that their impact is 1, short-term, and 2, extremely marginalized. But then let's go to their first subpoint where they talk about entrepreneurs. 2 responses here. The first response is that once again, we would say cross-applied McGee, who tells you that when they talk about entrepreneurs, they're only talking about investment into big businesses. And once again, remember the Center on Budget Policy Priorities tells you, which is that big businesses on net actually cut jobs. So if anything, this is a reason to vote for us. But second, my opponents numerous times in this convention and numerous times during this subpoint basically talk about how our lower taxes have led to increased small businesses. But this is a really key distinction because cutting a capital gains tax is different from abolishing it. If you cut a capital gains tax, there are still tax incentives like we talk about. However, when you abolish capital gains, you remove all these tax incentives, so there is no reason to vote. There is no reason to actually invest in small businesses. That's super important because they might have evidence saying that there's going to be increased small businesses, but that's not applicable because when there's a decrease in capital gains tax, there are still incentives. So we would say don't evaluate this. But then let's go to their second subpoint where they talk about that their main link into this is basically double taxation. One response comes from Robert Posen of the Brookings Institute, who tells you that even if you take out the capital gains tax, there were other sorts of taxes included, such as dividend taxes that actually companies have to pay. That's super important because even if you do take this capital gains tax out, there are other taxes, and therefore what you're going to be seeing is that double taxation still exists. This is not a reason to vote for them, and it's not a unique reason to vote for them because in both worlds, companies are being double taxed. But let's go to where they talk about foreign investment. What Littlewood of the University of Auckland tells you is that the capital gains tax is not a consideration for foreign investors, so really they don't get any impacts off this. But second, when they talk about Social Security, they don't really give you a warrant for why Social Security would decrease if you vote for us. We would say that you weigh our impacts over theirs because they don't give you a terminal impact or a quantified impact. We would say you prefer our impact of 168,000 jobs.
That's it. Yeah, we're running some prep right now.
Are you guys ready?
Judge?
Ishan?
Alright, let's start time now. Let's begin with my opponent's case, but one really important observation. The logic of my opponent's case is as follows. A capital gains tax is good because then we can lower the tax for certain areas and drive investment there. But this logic basically gives us our case because that assumes that when you lower the tax, you create more of an incentive. We say that when you lower the tax for every single sector, it still creates a broad incentive to invest in areas of higher risk and small businesses. And the reason is that when you have a small amount of capital being traded, then investors are obviously going to opt for low risk investments. They're opting for the blue chip stocks because they have a smaller amount of money. The more risky investments in venture capital and poor and dilapidated areas are a concern of last resort. So only when you increase the amount of capital available by the $2 trillion that we talk about do you drive investment into the areas that actually need it. I'm going to prove that with the evidence in the speech. But more importantly, on their first contention about opportunity zones, Ishan essentially eliminates this argument in the first crossfire. The opportunity zones project is a tax deduction, meaning that if you invest, you don't pay capital gains tax. However, the project is based on an initial tax credit. And the way we used to do this is that when you invested in a certain area, for example in low-income housing, which still exists in the status quo, you would simply be credited on other types of taxes, like income taxes. This is really important because if you abolish the capital gains tax, they don't just get to argue that the government all of a sudden stops caring about poor areas and stops caring about preferential treatment for small businesses. The government would step in and replace what are currently tax deductions with tax credits, which is what they've historically done in the face of tax cuts. That's really important because these comparative advantages would still exist and they're not proving to you a reason why they would go away. All they have to defend is that the standard tax rate goes to 0%. But even if you buy that these opportunity zones are a good thing, we are going to magnify their impact in a couple of ways. The first way we accomplish this is by increasing overall investment into urban areas that are dilapidated, specifically inner cities. Again, what I told you is that if you're going to have less money at play, you pick richer areas, you pick the stable bets. But when you have more money, it transitions into the riskier areas, which is why Tanner in his book, Fighting the Revolution on Capital, finds historically that the 1997 tax cuts, which cut from 28 to 20%, saw a 38% increase in business investment of black-owned businesses and businesses in inner-city areas that were historically impoverished because then there was more capital, so investors drove that investment to areas that didn't have it yet. But second and more importantly, voting for us also increases investment into housing developments in poor areas. What Leopold of the Urban Institute finds is that right now there are only 38 affordable housing units in these poor areas for every 100 that are needed. Fortunately, the University of Michigan finds that each percentage point reduction in the capital gains tax rate leads to up to a 10% increase in overall investment into low-income housing developments in poor areas. These housing developments then drive down rent prices in these low-income areas, allowing poor people to escape poverty traps and improving the quality of life in these areas as a whole through increased property tax funding and decreasing crime rates, which is why Patrick Sharkey of the Brookings Institution finds that creating affordable housing and integrating the housing market as a whole is the single strongest predictor of both poverty and income inequality in inner cities. So we're solving for a bigger problem than they are. Next on their contention about small businesses, there are a few problems here. The first is that, again, these incentives that they talk about will still exist in either world in the form of tax credits. But second and more importantly, they tell you themselves that 90% of startups fail. What's really important to recognize is investors can see when a company is about to take a turn for the worse, and that's when they sell. The problem is that if an investor sells because they think the startup is going to fail, now they're paying a tax, and that disincentivizes them from selling, which allows these companies to go down with the investor and therefore decreases startup investment. That's the problem we solve, which is why Moore of the IPI finds historically that the last time we cut the capital gains tax rate, there was a 50% increase in startup investment, so their entire argument is magnified. Their evidence showing a 20% decrease in startup investment assumes a temporary cut, and the reason it gives is that the money would go in and then come out. We are advocating for a permanent cut, which literally solves the problem their evidence talks about, which is why our evidence shows you that actually small businesses thrive under capital gains tax cuts, which is why jobs increase under capital gains tax cuts, turning their impacts against them. Thank you, and we urge an affirmative ballot. You ready?
Yeah.
Alright, let's start now.
Alright. So in your observation, you basically say that you create a broad incentive. So
Yeah.
what does that specifically mean?
Okay, so you can have the government lower capital gains tax rates for certain sectors, but they're never going to identify every sector that needs more investment. The only way to get the benefits you talk about in every area is to have a tax rate of 0 uniformly.
Wait, so I'm not saying that like. So what I'm arguing is that there'd be benefits in small businesses, and those are important because they like drive small business investment.
That's totally fine. We are arguing for more, which is why it increased by 50%.
So how do you link it? How do you link it to more?
Well, it's quite simple. A lot of small businesses, well, a couple of things. First of all, even if you're investing in a small business right now, you're still paying some tax. As Isham explains in Crossfire, that's still keeping some investors at bay. That's one problem we solve. The second problem we solve is that a lot of small businesses do not receive these tax benefits. For example, healthcare, education startups don't get the tax benefits you talk about because they don't fall under the IRS code that reduces their tax rate. So we solve that problem.
The problem is, let's talk about businesses first.
Yep.
If there's a small firm that had a 0% capital gains tax and a big firm that has 0% capital gains tax, wouldn't I be incentivized to invest in the big firm instead
Yeah,
of the small
well,
firm?
what we say, right, is that investors have what's called portfolios. They diversify their assets. So, if I have a portfolio of $100, I'm going to put it in these big companies you talk about.
Sure.
Now, in the pro world, some of these money that are locked up gets unlocked. Now my portfolio is $150, and that extra $50 is what tends to go to startups, because that's a
Wait,
smaller priority
if
for
I
these
wanted to make
investors.
as much
So when their
money-
capital
if I
pool
wa-
expands, it disproportionately favors small
if
businesses.
I wanted to make as much money as I wanted, and if I wanted to decrease the chance of risk, wouldn't I spend all my money on like the big businesses?
No, because startups produce a higher rate of return, but they have higher risk. Therefore, to diversify,
if
you'll
an
have
investor
some...
doesn't if an investor doesn't want to take that much risk, wouldn't I put that money into a big
Again,
business?
this is what a portfolio means, right? You put some money in low risk, low reward, and some money in high risk, high reward. When you decrease the amount of money available, the high risk, high reward is on the chopping block, and unfortunately, that's poor areas, that's startups. That's the problem that we are solving by unlocking $2 trillion of capital. Can I have a question?
Sure.
On our case, you make a bunch of responses about the lock-in effect, right?
Yeah.
You just say that the lock-in effect is marginal.
Yeah, it's insignificant.
Okay, your own study, which says that startup investment would decrease. In the sentence above the highlighted sentence you gave me,
So
what does
which
it
study?
say about investment?
Which study?
That there would be a 20% decrease in startup investment. The Tory evidence that I called for. The
Yeah,
sentence
yeah.
above you handed me, what does it say?
I mean, doesn't it say like crowding out? So if capital gains tax is abolished, there would be more investment to big firms.
That's not what your evidence talks
What
about
does it
at
say?
all. Your evidence says that a capital gains tax would drastically increase the amount of capital flows to small businesses. Then it says
Wait,
that
where does it
temporary
say that?
capital gains tax cut scenario would be bad because when the capital gains tax is reimposed, investors would pull their money out and these businesses would fail. Your own evidence has two scenarios for a temporary cut and no cut at all. Nowhere does it talk about a permanent cut, which is what we're advocating for.
No, but
and again, we have
the
history on our side.
sentence right after the warrant of the argument basically says that the reason why there would be decreased new firm appearance is because of the crowding out effect.
The crowding out effect is what?
Oh yeah, so
You haven't
the crowding out
explained that.
effect, it's basically what McGee tells you, which is that more big businesses will receive like more investment.
Yeah, our
and that
evidence
crowds
shows,
out investment
our
to
evidence
small
shows that
firms.
more money goes to small firms than big firms when you cut the tax. We give that evidence in case.
Alright. We're gonna run a little prep real quick. Alright, and we'll start that prep now.
Okay, everybody ready? We're gonna start on our case and then go back to theirs. Okay, let's start in the observation that the Vesh gives you at the beginning of the speech. He tells you that a low capital gains tax encourages high-risk investment. He completely ignores the warrant that we give you throughout our case that says if the tax rate is zero uniformly, there's zero incentive to prefer a small business over a large one, and we tell you that large businesses are a much safer investment. So if I had money to invest and I could invest in Apple and be guaranteed a high return, or invest in a small business and have a 90% chance of failure, I'm going to pick the large one. They don't interact with our warrant here, so you can flow this through. Now, our first main voting issue is opportunity zones. They first come up here and say that this is based on a tax credit plan, and that there would be other incentives if you eliminated the capital gains tax. But they give you no real description of how this occurs, and in the past they cite you no precedent. I have no idea whether or not this will occur. Make them prove that to you. But secondly, they read you these cards and say there will be more investment in inner cities to the degree that there's a low capital gains tax, because there will be more investment in general. But this is predicated on this observation that high risk investment will increase if there's a low tax. Don't let them continue to flow this through the round. We tell you that the main reason why there's investment in these low income communities in the status quo is because investors have to pay a lower tax rate. Keep that in mind throughout today's debate. And this grants us access to our impact, which tells you that there's 20% less poverty when you have these opportunity zones. Now, the second main reason you can vote for us is on small businesses. They only come up here and give this one response that says investors get locked in to the businesses that they're investing in. First, remember a card from Buttles of Harvard that tells you that only 7% of investors actually think this locked-in effect is a real thing. This isn't something that you can be considering in today's debate. But moreover, they say that investors can see the outcome of a business when they first invest. But this simply doesn't make sense, and they give you no reason why this is true. They also come up and say that that there's more investment in small businesses when the tax rate is low. Recognize that there is a key difference between having a low capital gains tax and having no capital gains tax, because even when you have a low capital gains tax, those incentives still exist. That's why we still have access to both of our warrants, which they ignore in rebuttal, and our impact that says that there would be 22% less jobs in small businesses if you voted pro. That's why we urge a comp ballot.
We'll use a little bit of correction.
Everyone's good? On our case, there are two reasons we give why investment increases. I just have to prove one to win, but I can prove both. The first is about risk return. You don't see them mention this in their summary speech at all. That's really deadly, because the fundamental premise of this argument is that every investor looks at how much risk is happening versus how much reward I'm getting. And by abolishing the capital gains tax, you guarantee an increase in the amount of reward you're getting by eliminating the amount of tax they get long term. But the risk that changes is only with these But the risk doesn't change, which is why you see an empiric increase in the amount of investment. There are a lot of empirics that I'll get to more on their side of the case, but keep that in mind. The second thing we tell you is the lock-in effect. He just says only 7% of these economic investors actually do this. There are two responses. The first is that their own card that they read in case specifically tells you that the lock-in effect has a huge impact on the economy. But second, even if only 7% of the economists do this, they constitute a majority of the wealth in the stock market in the first place, which is $2 trillion, which is why our impact is so big. This is really important in winning us the round. But with this in mind, let's go to their case, and this is is why our observation is true. If I have only $100, I'm going to invest that in Apple. If I have, let's say, $200, then I'm going to diversify my portfolio. The modern portfolio theory was created in 1950s. I don't put all my eggs in one basket. That's not what happened. I diversify my portfolio in hopes that I get higher risk and higher reward investments. This is the fundamental theory of economics. There are a couple terms and empirical reasons why this is true. The 1997 tax cuts led to a 38% increase in black investments. The U-Michigan card tells you that for a 1% decrease in the CGT, there was a 10% increase in low-income housing developments, which Sharkey tells you is the best way to solve for poverty and inequality, which means that we are helping the middle class and actually solving for the impacts that they don't extend in case. But finally, the more evidence is very explicit in saying, because of the reasons I said, and because of diversification, a decrease in the capital gains tax and abolishment will lead to a 50% empirically increase in the amount of investments in these startup activities. This is because, again, the tax credit and opportunity zones will still exist in our world because tax credits will always be made up by the government, and it always has historically whenever there has been tax cuts. And it is for these reasons that I urge a negative ballot in today's affirmative ballot in today's.